The views and opinions expressed in this podcast do not necessarily reflect the views or positions of Acuma, its board of directors, its management staff, or its members. The podcast discussion presented is conversational in nature and for general information only.
Hello and welcome to Actors on Point Podcast, a series focused on sharing the stories of people who are making a positive impact in the credit union mortgage industry. I'm your host, Peter Benjamin. Before we get to our episode, just a quick word from our sponsor.
This episode is brought to you by Consolidated Analytics, helping credit unions make smarter mortgage decisions from origination to servicing and beyond. With expert valuation, risk management, and compliance solutions, they provide the insights you need to protect your members and grow your portfolio with confidence. Whether it's due diligence or a collateral risk assessment, they help you navigate the market with ease. Learn more at consolidatedanalytics.com.
Welcome to the second episode of our Compliance Summer miniseries, where each episode will feature an intimate conversation with people who I consider to be experts in their field and supporters of the credit union movement. As a reminder, with each of these episodes, it's our goal to take a deep dive into various compliance topics that are impacting and reshaping the credit union mortgage industry. Our next guest in the compliance mini-series is Laird Nossuli, CEO with iEmergent. Laird, how are you doing today?
I am good. How are you, Peter?
I am fantastic. I'm excited for our conversation today, for a couple reasons. And we talked about this, and I always sandbag, but we talked about this topic, and the topic is HMDA. And I'm always sandbag a little bit, but it's a topic that I have grown to better appreciate as my time as president of Acuma. And that's all I'm going to give away for now. But I'm excited that we brought you here because I consider you to be one of the foremost experts on the topic, on the subject, on the act. And so thank you very much for being here.
You're very welcome. I'm happy to be.
And so, but before we get to the meat and potatoes of the conversation, let's bring Justin in like we always do. Justin, the Hawk, how are you doing today? And please tell us what is the latest and greatest happening over at Acuma.
I'm good, Peter. How are you?
Living the dream. Thank you very much.
Awesome. Over here, we finished up the first, I like to say it's the first half of the year for our in-person events.
Sure
so all of our workshops are done. Our summits are done. Annual registration. It's been open since April. It's not like it's a secret, but it has officially launched again. We do that in June every year. So relaunched a couple weeks ago, so we're really excited. The agenda we have, the speakers that are lined up, it's absolutely amazing. I think the after party, I was listening to one of our recent episodes not too long ago, and the whole after party conversation just had me cracking up because I don't think we've come up with another name for it yet. I think we're still calling it the after party that's happening on Sunday.
I don't know if we're going to call it anything besides a pre-after party. I still like the idea of a tailgate, but it's not a tailgate because there's no cars. But anyways, we'll figure something out.
Ooh, that would be that's something that we could do. Bring out the grills and stuff, like have everybody have a pit boss or something come out and do some barbecue.
Yeah, but we can't do that in Vegas though. In Vegas we probably can get fun, like we can do they have the Fountain Blue next year has an awesome pool, so maybe do a pool party.
There's something. See,
look, the wheels are turning.
We're already planning 2026, and we haven't even had 2025 yet.
Let's do it.
But annual's coming up. It's going to be September 21st to the 24th. It's going to be in Denver, Colorado. So if you haven't already, go to the website, register. Come make your mark with us. It's going to be a spectacular event that you're not going to want to miss.
Lots of surprises.
Anybody's ever met you, they know that you have some tricks up your sleeve.
Always. There are some killer surprises this year.
The one surprise I'm going to say that we're very sad we didn't do is you come riding in on a horse. That would have been epic.
Yes. So Laird, we tried, so the Broncos have like a real horse.
They do.
What's it called? Thunder. We tried getting Thunder the horse, and the more we went down the path, it just seemed like a really bad idea. And so we stopped going down that path. So it's just. Yeah.
So just to give everybody that idea, if that was one surprise, just imagine what else we have in store.
Yeah. Laird, what were you going to say?
I was going to say that would have been my son's dream. He's a Broncos fan, and we're horse people. If that had materialized, that would have been the most exciting thing to my son ever. Thunder, huh?
Thunder, yeah.
Yeah. Well, if you can't make it to annual, which will be very sad if you don't make it to annual, but if you can't make it, don't worry. We have plenty of other things going on. We have our marketing network Q3 meeting that will be coming up next month. So be on the lookout for information on that. And then we have our webinar series, our fast tracks and inside tracks. Those are happening year round. And then lastly, our favorite, the On Point podcast, which just helps keep the fun and learning going all year round.
Awesome. Thank you, Justin.
Thank you.
All right, Laird. So again, as I mentioned, we're going to talk about HMDA. But before we do that, I always mention this and I always talk about this, and we have to stay with the roots of the podcast before we dive into HMDA. This pod is based off of a people piece. And so before we even dive into HMDA, it's about sharing the stories of people who are making a positive impact in the credit union mortgage industry. I consider you to be one of those people. And so the first question out of the gate is always the same. The last question out of the gate is always the same, or to leave the gate is always the same, or to end the podcast is always the same. So the first question is, who is Laird? So that's the first question before we get into HMDA, before we get into the real conversation. But the first question is, who is Laird? If you could, for those who don't know you, share your story.
Okay, I can do that. So Laird Nossuli, I'm the CEO of iEmergent. I'm also the daughter of iEmergent's founder. And I am a passionate, purpose-driven person, specifically around closing the homeownership gap. And I inherited, along with my husband, who is our COO, Bernard, the company when my dad had a lung transplant, and unfortunately fought a lot of challenges, and we lost him in 2016. With that being said, though, we've changed the focus of iEmergent and have grown a lot with information and data and technology that really has allowed us to reach out to lenders of all sizes, types. Absolutely loving working with credit unions because of the mission-driven mentality. Me, besides that, I have two children. They're 12 and 15, and I'm a avid equestrian. But I love data. I love data not as much as my family or my horses, but I really do love the data. So is that enough information? I can.
That's perfect. And you forgot to mention. Your ear off. You forgot to mention that Bernard is a fellow Commanders fan, and I appreciate that very much about him.
Yes. I bet he appreciates that about you as well.
Yes. I always appreciate a good Commanders fan, especially when I run into them, because I feel like it's been a long time since we have something to be proud of, and we finally have something to be proud of. Anyways,
yes.
Because there aren't enough Commanders fans in Maryland already.
Well, I mean,
there aren't though. Well, maybe there are now.
Now there are, but
now there are.
Yeah.
Everybody came out of the woodworks.
I mean, I've been, Commanders fan my whole life, or whatever they used to be called. But the thing is that I remember going to games and there were more fans of the opposing team at that stadium, and it was just heartbreaking. Now, when you go to games, there's more Commanders fans, and that is a good thing to see. Anyways.
Did you know that we named our dog Riggs after John Reagan?
That is awesome. That is awesome.
Yep.
That's amazing. That's good name. Good name.
Yeah, it's a big part of Bernard's background in life. And I think he would have felt your pain, but is certainly experiencing your joy right now.
Yes.
Excitement.
Where is it? Hold on. You can't see it because it's not a good signature. Daryl Green.
Oh, that's very cool.
And for those, and obviously this is an audio only, but I just held up like a mini Redskins helmet, old school Redskins helmet that's signed by Daryl Green. So, anyways, I digress. So, Laird.
Yes.
Focus on the conversation of HMDA. So, you and I talked about this, pre-recording. And so the reason why we selected this topic, because, yes, HMDA has been around for a very long time. And, HMDA is just one of those things that, we do on an annual basis. But here's the thing. I've come to appreciate HMDA during my time here as president of Acuma more and more every single year. And I think it's for a couple of different reasons. I think there's been more attention brought on credit unions by, big banks, community banks, for various reasons. If you think about, the tax exemption for credit unions, I think you could easily tie it back to HMDA. HMDA very much holds hands with fair lending. If you look at, recent redlining cases, you could easily tie it back with HMDA. And so I've come to appreciate the need to understand HMDA, your data, more and more. And, for me, having sat in our listeners' seats, about almost 3.5 years ago, just shy of 3.5 years ago, for me, the need to file HMDA on an annual basis, it was just a necessary evil that we filed and we forgot about to the following year. That's all it was. Just, oh, great, it's March again. Let's follow our HMDA and let's do it and get it off our plate, and let's get back to closing loans. Right? There was no analysis. There was no deep dive. There was nothing about us looking at the actual data. Not only that, it wasn't just mortgage. There was nothing from the compliance department. There was nothing there was no look back from a fair lending review, nothing. And I'm going to take it one step further. Again, I said this before. Hindsight's 2020. Thinking back to my community bank days, I wish I would have shown more appreciation for my compliance officer's time when she pulled me into her office, because I was the head of ops for a mortgage division for a community bank. And whenever we did that fair lending review, which is really based off of HMDA, I really wish I would have shown her more appreciation when she would just kind of walk us through our fair lending review. Because I just sat in her office and just rolled my eyes and basically saying, "What do you want me to do? Like, this is the data is the data." And I would just pretty much be snarky the whole time, right? But there's so much we can learn from this data. And I truly think as though, regardless of size, credit unions can learn a lot from our data, and we're not leveraging enough. Not only that, we're not using it to our advantage.
Right.
And people are using it against us. And so that's why we're having this conversation on HMDA, because it's such a vital tool for us. So, but before we talk about how we can leverage it as a tool, let's talk about HMDA itself. So you're the expert. So walk us through HMDA.
So HMDA, Home Mortgage Disclosure Act data, really is the deliverable that was resulted from a law, like you said, a long time ago in 1975. It was really, and its purpose then and its purpose now is to ensure transparency in the industry and to collect good data, consistent data on at a loan level, or actually an application level, for all residential mortgage applications and originations. And it's changed a bit over the years. We've been working with it since 1999 is actually the first year that we have data. And I will say that in 2018, the data became far more robust. Reporting really improved. And your abilities, or the abilities of institutions to use it, not only, kind of like you said, Peter, to, a have to and a protection, as a sort of a shield, it can be used as a sword because it is actually really great. Even though it's retroactive looking, it is really great for looking at and setting goals for the future. But part of that is better now because of the robustness of the data. So really it tracks a number of things on the loan. It is focusing on the loan itself. What's the rate spread? What's the application, I should say. Rate spread, lender, loan size, the points collected, so you really get a complete picture of what a loan looks like, and you get a relatively good picture about what the borrower looks like. And when you put all of that together, and the LAR, which is the raw data set, is called the LAR, which is the loan application record. When you look at that data at an aggregate basis, like whether it's for just, if you have a small footprint for the U.S. for a particular census tract, you really learn about lenders, products, and you learn about markets. And that market piece is one of the ones that I think has been left off the table. So often what HMDA is, the analysis is, how are we doing compared to our peers? And it ends with that. That is where I think there's that loss of really valuable information to, in a sense, take that conversation you had with your compliance person and unify it with sales. And it's really in how you look at all of the data on its own, as its own great source, because one of the things about it, because it is collected annually and it is collected in a very completely consistent manner, it's clean data as far as data go. I mean, there is data out there from recorders' offices where you can find out, information on loans, but it has none of the rigor around it of consistency that HMDA does. And that is what is so critical about it for so many different reasons. But the other piece that it adds, again, away from the peer group look at, compliance, it also adds, if you look at it over time, even though it's retroactive, and I can talk about how it retroactively influences the data that we create or provide, that's proactive, that's a forecast. But if you look at it retroactively, you can see patterns in it. For us, we look at patterns in every census tract, in every market has a pattern. And what's interesting is, even though we think we can't predict mortgages or where originations will be, we can predict those patterns. And when you take those patterns and you use what you've learned from HMDA and you tie that with demographic data, you do get a better idea about what the future could look like. But that, again, what is so valuable about HMDA looking backward is it really is a time series. I guess it's a blueprint for what is happening competitively and how the industry is changing. And since it's relatively sticky because you only get it annually, it has enough consistency that really start informing a baseline, just a baseline though, for strategy moving forward. It's not easy to collect. I'm sure that, Peter, that's probably part of the reason you rolled your eyes. I mean, it has to be very specific. It's reported by nearly all lenders. There are lenders that are exempt, and they just raised the threshold. I think it's 100 transactions now. And so you also don't get any information from brokers on it because it's really reported by the lender, both the correspondent and the broker lender, but it is the lender that's recording it. So you get a lot of information at a market level. You get a lot of information about trends at a sort of an industry level. You get a lot of information about your own institution, and you get a lot of information from HMDA on the competitive landscape. Those things together make it very valuable internally. On the external side, though, it really is what helped maintain transparency. As you said, this informs fair lending practices. That was its whole point. It does that well. Also, for institutions that have CRA responsibilities, it's also a fantastic way to track it. And again, part of that is, even though it's a lot of work, it has tremendous value because it's so structured and consistent.
So it is a lot of work, right? Mm-hmm. But here's the thing: it's. And I'm not trying to, pause for a dramatic effect or anything like that. But it's a lot of work, right? But for me, just looking, and again, I'm looking in from afar, right? I'm not part of the process. I'm not part of a mortgage operations right now, right? But a lot of credit unions, let's be honest, volume's not up. Right. Volume's down. Right. Yes. If you look at what Freddie Mac is saying, MBA is saying, a lot of economists are saying, we should end the year better than 2024. So 2025 should be better than last year. Yep. Right. But still volume's down. If you have enough time to implement a new technology, you still I'm sorry, not every single one of your resources within your mortgage department is at capacity, right? You still have time to look at the data, right? And I think you can agree that if you get into the routine of doing it, the routine comes easier the more you do it.
For sure.
Right. And whether you're looking at, the public data set or your internal data set, I guess the internal data set's probably better for your own review because there's a lot more information, right? But why wouldn't you want to go down that path? I mean, if it's a daily routine or a monthly routine or something like that, I mean, why wouldn't you? I mean, because you know what? Your competitors, bank lobbyists are using your public data set against you.
Right.
Why wouldn't you want to get into the routine, regardless of size? Why wouldn't you want to know that, right?
I think a lot of it comes from the fact that there's so many data points that people don't know where to start. They don't know which data points matter, how to use it. It's all there. And in our work, we so often have to show people what they should be looking at. So I think that's part of the why wouldn't you? I don't know.
But, it's a couple things, right? Yes, HMDA can help you figure out, okay, where am I lending, right? Where and who am I lending to? Am I lending equitably across the board, across the spectrum, right? But also, am I lending in my footprint, right?
Yep.
And if I'm not, okay, I need to make some strategic decisions to start moving towards that footprint, right? I think that's 100%. The most important thing, right? And I think if you look at the most recent redlining case, I think that's a perfect example of how the data wasn't being leveraged,
right,
for that exact purpose, right? I mean, or am I off base?
No, you're absolutely right. I mean, the location of it is so important. We map it. It's very, very easy to see because even though the public data set doesn't have a dot, a point, it doesn't have an address, it has a census tract. If you're looking at your data, you have the address, so you can plot it on a map. but you get a visual representation of whether you're representing your footprint. It's a very good way just visually to start looking at concerns ahead of time about, fair lending and redlining. But the piece that I think gets lost is that you are looking at your data to see what you're covering, but by looking at who isn't being served. For example, if you look at the market and you look at the applications that are denied, withdrawn, or incomplete, mainly with denials though, and you do more of a deep dive, you can get some great ideas for products, because it's also showing you where there's not untapped need, but need that's there. If someone went to the extent they think they're close enough on the home buyer journey to have an application, but they were denied. If we get a sense of why they were denied and we start looking at solutions that would overcome that one denial or two denials, it's the patterns of that, then you start thinking, hey, there's nobody here that's able to lend to this with this like program for this, this type of borrower. And I think that's what's one of the things that's lost. The same thing time is if you look and you use that beginning idea of, are we lending in our footprint? And you find what we call gaps in coverage, like big holes, whether it's a segment hole or it's a actual geographic hole. The data give you a starting point for saying why. And you can look at, well, what products are we using? What are the patterns that we're seeing? You can use the public data from HMDA. You can use your data in real time. And then you can figure out how to use your real data that you're going to submit to HMDA with some of the more current county property data. And that mix of all of those together paints a very clear picture about, what are the patterns? What's the opportunity been? What opportunity did I miss? And what opportunities do I have for the future? And it's when lenders are able to make that switch to the future that they start getting excited about it, because it's no longer an eye roll. It's this is my strategy for growth, whether that be growth, first in mortgage, but also growth with members.
Right. And I think you went down, you brought up several key points, right? This is not just a mortgage thing. Yes, it's Home Mortgage Disclosure Act, right? And I fully respect that. But the entire credit union can leverage this, right?
Oh, yes.
You can back in. If you look at this data report and you map it out and you look at the census tract, in many ways, you could reverse engineer where you need to open a branch.
100,000%.
Not only that, marketing should leverage this for strategic initiatives, right? Compliance should use this in everything that they do, right? Mortgage, obviously, product development. You name it. So right now you have branch operations, you have marketing, you have compliance, you have mortgage. Everyone within the credit union basically has a stake in this reporting. But all too often, again, the credit unions are not looking at this. It's just, all right, well, again, let's just file it and be done with it, and it's not worth it, and I don't get it. Whatever, it's not worth my time. But
I think it goes back to that. What does it tell me about like that? And I think you've heard me say that we're running a sprint and a marathon, and we need past, present, and future data. Like again, I say it's like people, markets, and in this industry, it's like a person. It's what's happened influences what's happening today. But the future is also influencing what's happening today. So you can't separate. You have to have this continuum. And the way you start with that baseline, where you start using it and starting to make a difference, is with that pattern historical data. But it allows you to, it's a complete enough data set that it allows you to start setting goals. And that could be a goal for the institution. It could be a goal for a loan officer, but it gives a starting point. And that's something in general, lenders haven't been particularly forward thinking, because they thought there's no way to predict interest rates, so you can't predict what's going to happen. The data, when you look at it, are not suggestive of that's why we have our forecast. But when you look at that idea of what happened, what did we miss, and how can we make sure we don't miss it for the future, you start thinking about goals. And people like goals because it helps them identify and quantify what it means to be successful. So what those goals look like, whether it's a number of a certain borrower type, an actual location, or a particular product segment, you have so many paths.
Right, but interest rate only takes you so far.
Absolutely.
Right. So being able to predict interest rates, we can't solve for that.
Right.
Right. We can solve for inventory. We can solve for the availability of products. We can solve for the affordability of the individual loan, right? But we can't solve for interest rates, right? So what we can do is go into a diverse community. We'll say predominantly Hispanic community, because that's what the census tract tells us.
Yes.
Right. And build a relationship within that community, an area that we haven't had a relationship with in the past.
Right.
One that we should do better in, regardless of interest rate, and build a relationship. And we lend. And you know what? The fact that we're in there, build a strong relationship, they'll come to us. Because we have a strong relationship, we build trust. We make, again, we're not solving for interest rate, but we're making it affordable, and we are making it, we're helping them solve for the inventory issue. And we're, again, affordability, access, and inventory. If we're solving those three things and we build that trust, that's it. We're done.
Yeah. Yeah. I mean, you hit the four gaps that we trust, education, credit, and inventory are the four major gaps. And the barriers that come, you said something interesting about we can't solve for credit, or we can't solve for interest rates. And that's true. But if you look historically, my dad wrote an article, and this was 25 years ago, and we updated it, and we hardly had to change any words. That's how much little things have changed. And it's that interest rates don't buy mortgages. Particular financial indicators don't buy mortgages. People buy mortgages. And regardless of the interest rate, people change jobs, they move, they have families. So there's always going to be a purchase market. The size of the purchase market is going to be, and who is buying is going to be influenced more by rate, but it's going to be there. Refi, I think you're going to see that with refi. But even now, there's so many more ways to leverage the equity in your home for other financial purposes that again, rate matters, but it doesn't matter the way people think it does, because you're always, life happens. And what you said is so critical, specifically with diverse and historically underserved communities. They have not built trust with banks. And I've seen this with so many of my clients, and I've seen it on the ground working with, potential home buyers. If you are the lender, the partner, the financial partner that comes to the table, listens, and even if that's you're going to ready to, have a loan in 6 months, or it's a 2-year, 3-year plan. If you're that lender, then you are going to have a partner, and then they will have built trust. That within that community, though, the loyalty is incredible. So you are not just building the relationship with the person that's going to potentially buy a home in the next 6 months. You're building with the families. You're building with the communities, because they say, finally, hey, this credit union, let's say I'll use Boeing. Boeing, we can trust them. You can trust them. They got me the dream of home ownership. So this ends up becoming, you invest this much time and you get, 5 times that back. Right. But you're so right that trust piece is huge.
And Boeing's a good example. I mean, the team over at Boeing has done an excellent job of diversifying, their entire lending practice, right? I think you and Roger presented, at one event. Mm-hmm. It was fascinating what they've done, right? Just expanding to a more diverse community. But anyways, I would love to, go into more of that. And I feel like we probably could. But just for the sake of time, we have to stop, right? But we have to start transitioning.
No, we don't have to. Are you sure?
I mean, we yeah.
Yes, you do. I know.
We do. But before we do, last question. It's always the last question. Actually, the second to last question. I'm going to second to last question. Any final thoughts on HMDA and the importance and what credit unions should be doing, and or better yet, how credit unions can leverage HMDA to their success?
So I think, and I'm going to be clear here, and if any IMBs, independent mortgage banks, are listening to this, you should listen really hard. I think that with lending the way it is now, with the change in the regulatory environment, credit unions and community banks have an incredible opportunity to grow and I say take share, but I don't mean it in that like we're just going to fight, to grow the pie. Okay. And here's why. I think if that data is used, and that data is used to find and fill gaps in coverage, to better understand who is and isn't being served, and then to set that path forward, I think in the next 2 to 5 years, it's an incredible opportunity specifically for credit unions, because people need to be thinking about the whole person, the whole household. And nobody does that better than credit unions do. So I encourage this not as a compliance strategy, as the central growth strategy, to use data, whether it's start with HMDA, then bring in these other pieces, the demographics. There's so many data pieces that you can bring in and develop strategies after that. And you will see success. I guarantee it.
Okay. I love it. Great final thoughts. All right. Real last question.
Oh, no.
No, this is an easy one. All right. So what keeps you going? What keeps you motivated? Again, going back to the people piece. Again, the podcast is all about, people make a positive impact. But what keeps you going? What keeps you driving day in, day out? What keeps you going?
Equity, housing equity, the vision of my dad. But it's really I get to work with so many wonderful practitioners. And through that, we meet potential home buyers. Being a change maker and watching people really start to achieve what they've hoped for, that keeps me going. But mainly other practitioners, particularly practitioners who are people of color, the way that they get up out of bed, the way that they don't complain, the way that a challenge is put up, we go around it. I'm starting to be driven by my fellow change makers. And just at the end of the day, community is probably the biggest thing. Home ownership is that, but healthy communities just make everybody's in that community world better. And that's really what it is. There's lots of pieces. I get pretty emotional talking about it, so I think I'll stop with that.
Okay. Love it. Absolutely love it. All right. Well, thank you very much. Well, Laird, it's time that we transition to the second segment of our podcast. And for our summer mini-series, we're just sticking with the fan favorite of dad jokes. This is the most requested segment that we do. We might as well just call it the dad joke segment and forget Jeopardy. I think Justin would probably like that we just dropped Jeopardy because he's like the champ of losing.
No, I still like Jeopardy. I mean, I like my 5 wins. Don't take those from me yet. 5
wins out of all the episodes that we played Jeopardy. He has 5 wins. I think
there's only
4.
been 6 episodes.
That's not true. There's been like 30 episodes of Jeopardy. And he's only won like 5 times.
Let me just at least look good once.
Okay, that's fair. All right, fine. All right, so we're gonna do the most requested segment of dad jokes. So, Laird, prior to the recording, I asked you to come prepared with 2 to 3 dad jokes. But for the sake of time, we're gonna stick with the 2. So here's what we're gonna do. We're gonna do you do 2, Justin does 2, and then I'll wrap up with 2, and then we'll close out. Sound good?
Okay.
Perfect. Fire away.
First one. My dog ate all the tiles in my Scrabble game last night. I took him to the vet. No word yet. The other one is, I'm going to get this one wrong. A salesman approached me about buying my coffin. I told him I wasn't interested because that's the last thing I need. That's what I got.
That's good. Good delivery, Laird. Good delivery, Laird. So you were worried about it. You were worried about it. It was good. It was good. All right, Justin, hit it.
Why doesn't the sun need to go to college?
Why?
Because it already has millions of degrees.
You like that's important. I like that.
All right, good. Good.
Come on, that was a good one. What's the only thing that can ruin a Friday?
What?
Remembering it's Thursday.
That's good.
That's good. All right, I'll wrap up. I started telling everyone about the benefits of eating dried grapes. It's all about raising awareness. Okay.
The puns are the best.
They sure are. Which one? Okay. Why would a pig dressed in black never get bullied?
I don't know why.
Because Batman has always sworn to protect Gotham. All right.
Good ones.
Thanks. All right. Well, that wraps up this episode's version of Dad Jokes. Laird, thank you so much for everything that you do for Acuma, and of course, sharing your valuable insights on HMDA. And I would be remorse if I didn't mention that, iEmergent, it was a valuable member of Acuma services, and Acuma members receive an amazing discounts on the services that you provide. So again, thank you for being a partner in that.
Love it.
So again, thank you very much for being an amazing guest on our summer mini series. Love the conversation.
Likewise. Thank you so much for having me, Peter.
Of course. And Justin, thank you.
Of course. My pleasure.
Absolutely. And to close out, thank you again to Consolidated Analytics for sponsoring today's episode. And to all of you, we know your time is valuable. Thank you for tuning into the latest episode of Acuma's On Point podcast. We hope you enjoyed it. Until next time, be well, my friends.
Thanks for listening. We'll see you next time at the Acuma On Point podcast. If not already, be sure to subscribe and give us a 5-star rating. For more great episodes and information, be sure to visit us online at acuma.org. And to get the latest updates, head over to our LinkedIn page.